Tech companies have spent the last year slashing thousands of jobs. Snap is laying off 10% of its workforce. Okta and DocuSign are cutting hundreds of employees. And indirectly, memos continue to leak out to the press blaming the same culprit: artificial intelligence. The corporate messaging implies a rapid technological takeover. News broadcasts and market analysts echo the idea that AI systems have suddenly become sophisticated enough to entirely replace entry-level jobs and run administrative workflows without human help. But inside these exact companies, the retained staff are experiencing a very different reality. Employees are spending their time doing a new category of work, reviewing the automation tools and fixing the constant errors the AI makes. This chart visualizes a standard administrative job, broken down by tasks. At current technological limits, only 24% of these workflows can actually be automated. The vast majority of the role strictly depends on human skills like negotiation, coordination, and physical presence. Corporate executives are publicly announcing mass layoffs under the banner of automation, while simultaneously deploying technology that cannot independently complete even a quarter of a standard office role. If the systems are genuinely too primitive to run entire workflows on their own, why are corporations firing so many people and pointing the finger at the bots? The immediate assumption is that AI saves money, making human workers redundant. But building the specific technological infrastructure required to run these programs costs millions of dollars before a single workflow is automated. This graph compares standard technology budgets against the capital required for advanced AI. Meta projects its total expenses at $99 billion, yet enterprise rollout is complicated. Only 3 out of 10 corporate AI projects successfully expand without stalling or failing. What the technology does actually accomplish in its current form is acceleration. Programs that analyze data or generate text act as a complement to existing employees, increasing human performance by around 35% on certain tasks. Because 9 out of 10 business operations still strictly require human intervention, introducing AI into a company right now is a massive, highly experimental expense. It is mathematically very hard to cut headcount using AI alone. To understand the real driver behind the staff reductions, we have to look back at the recent years of rapid economic expansion, when technology companies simply hired too many people. This aggressive hiring created severe organizational bloat. In many companies, up to 30% of internal positions became supervisory roles. These layers slowed decision-making and inflated costs. In 3 years, tech sector operating expenses soared by more than 20%. Eliminating 3 levels of middle management at a time is a calculated financial correction. These companies are purging layers of bloat to move faster and reset their budgets, independent of any automation breakthroughs. This puts corporate executives in a difficult position. Admitting to Wall Street investors that their core business is deteriorating or that their administrative costs are spiraling out of control usually results in an immediate drop in stock price. But investor demand for artificial intelligence hardware is at an all-time high, heavily driven by figures like NVIDIA CEO Jensen Huang, whose data center revenues are growing at massive rates. Wall Street is currently buying into anything with the letters A and I attached to it. Executives are leaning heavily into this market enthusiasm. Over the last 4 years, companies explicitly mentioning artificial intelligence in earnings reports and public presentations jumped by 250%. The market strictly rewards this behavior. By announcing an artificial intelligence initiative on the same day they announce staff restructuring, some companies see their stock prices jump nearly 12% in a single trading day. The AI layoff is a highly profitable PR strategy. It gives corporations a cover story, allowing them to rebrand panic-induced budget cuts and the firing of thousands of excess managers as visionary technological innovation. The idea that algorithms are suddenly taking over the corporate workforce is a myth. The current wave of mass layoffs is standard corporate restructuring, driven entirely by Wall Street pressure and past overhiring. While these cuts offer short-term financial relief to shareholders, they cause severe long-term damage internally. Complex organizations rely heavily on the accumulated knowledge of their workers, and when that specialized experience disappears, rebuilding it is notoriously difficult. Eventually, companies have to replace the talent they cut. Labor market data shows that hiring and training a new specialized employee can cost a business up to 40% of that worker's annual salary. This graph compares two distinct corporate strategies. Organizations that maintain stable workforces and retain their internal talent end up growing up to 18% faster than the companies executing mass, short-sighted layoffs. The companies actually succeeding with this new technology aren't firing people. They are gradually introducing the tools and investing resources to re-skill current employees, teaching them to harness systems for greater autonomy and speed. Artificial intelligence currently serves as a convenient shield for executives to balance their spreadsheets. When the next company announces a mass layoff blaming the bots, the real story will likely be found in their administrative costs and investor reports.